Alright guys, well, two more massive companies just reported, and it seems like Wall Street has completely gone bonkers and sent them both in opposite directions. And amongst us, the retail crowd, we seem to be thinking the exact reverse of Wall Street on these two stocks. So let's discuss exactly what Wall Street's saying, kind of talk about the retail narratives around these, and kind of get down to what matters in the end for both of these companies and whether or not we should actually be looking at these companies or looking somewhere else altogether. Just make sure you like the video if you like getting the truth out the hype, because that's exactly what you're going to get today, guys. And speaking of earnings, the earnings flash sale is ending for my group, where you get to go through earnings with me. You get free coaching, free courses, access to the best 6, 7, and 8-figure Discord out there, guys, because there's so much involved. Just check out the pinned comment down there if you're interested and take advantage of that sale before it ends. But we got to jump into the video right here. Let's see what Wall Street's saying, and let's see what the truth is. Let's separate truth from the hype.
Jenny Horn is with us, host of Next Gen Investing, and we're looking at Apple, which reported yesterday. There was some really interesting parts of this and some better news than expected. People have been beating down Apple a lot lately. There were some bright spots. Jenny?
Yeah, as our second worst performer of the Mag 7, I will say there was a bit more room to work with, as opposed to, say, like, your Amazons, even Microsoft, which was at all-time highs.
Second worst. Let's see if we can figure out who the first worst is in regards to the Mag 7 who's reporting right now. I'm not going to say anything, I'll just let you guys comment down below and you let me know your thoughts.
But Apple has been definitely seen as the disappointment of all the AI spend. And just so far, its AI offerings have been, frankly, missing the mark. But they did still report, their biggest revenue growth pace since December of 2021. So that was huge. We saw earnings that topped expectations, as well as revenue that also rose substantially. And the all-important iPhone sales were up 13% year over year, with that pace of revenue growth at about 10%. But
yeah, those iPhone sales was actually a nice surprise there. I'm right there with you guys. Like, hey, it didn't really look like much different from the previous year's iPhone. But I mean, if they're able to outpace the previous year's iPhone, when that was kind of a semi-updated version of the iPhone, take that for what you will. Nonetheless, seeing that up is big. And I remember everybody saying, oh, well, this isn't, iPhone sales are going to be down again. That was everybody's prediction in October whenever the new one was released. And obviously that's not true. They're up once again. I don't know. It's just simply amazing how that continues to be that kind of cornerstone, that kind of rock. They're by far and away not the best phone. Let me be abundantly clear. There's lots of phones with lots of better options, better cameras, better features, better everything in the world. But yet here it is. It's the #1 selling phone and continues to grow in that category. And of course, we all know how the Apple ecosystem works and everything else in terms of getting you locked in to where it's really, really, really hard to leave. But that's not everything. That's not everything. Not every part of the business there. So let's see what else they got to say.
Shares rising, at least this morning, as overall most of their segments, as far as expectations versus actual numbers reported, beat. We saw earnings per share top, revenue also $94.04 billion. That was a beat. iPhone revenue $44.6 billion versus the $40 billion expected, as well as Mac revenue beat at $8 billion, and other products revenue. That was somewhat of a disappointment, as well as iPad revenue. And also, they can very critically watch now, services revenue was around $27.4 billion versus the $26.8 billion estimated. They provided what they called color, about the performance overall in the September.
Yeah, right there, services. I don't know why she lumped it in with the iPad sales that were down, but nonetheless here, I think she's got her notes jumbled up. But nonetheless, the services, if you look at the growth pattern on the services, it almost, I'm not comparing it to AWS in terms of importance and things of that nature. I'm comparing it in terms of growth. AWS, when it first started, was a joke. Ha, ha, ha. Why is Amazon even doing this? Who freaking cares? And now it's a behemoth and one of the biggest drivers of profits to the bottom line for Amazon. That's exactly what services is turning into for Apple as well. It is growing. It's growing rapidly. And it is a much higher margin business than iPhones, for example. And it's growing. So although we're not seeing the high-flying numbers like we're seeing a lot of other places, you are seeing this steady growth on the back end there, and something that doesn't get the headlines and may not get the headlines until all of a sudden it's here and it's like, whoa, wait a second, where did this come from? Look at all these profits they're generating from it and everything else. Nobody else produces more free cash flow than Apple does. It's not even close. You can go find the charts out there for it. I wish I had one handy right here. I wish they'd throw one up. Maybe they will. Who knows? But nonetheless, that right there, it is astonishing how much more free cash flow they spit off than all the rest of the Mag 7. I think you can combine them all, and they don't equal what Apple pushes off. It is just simply amazing how much free cash flow they spit off as a business, and services is only going to make that number larger and accelerate in the future. Got to keep that in mind. Now, that doesn't mean it justifies paying a whole 10 ton for Apple or way overpaying for Apple. I'm not saying that at all. Just saying when we start hearing about growth declining and they're dying and all these other things of that nature. That's where you got to dig a little bit deeper there, get away from the narratives, get into the financials, and actually see what are you looking at from the business there.
Per quarter so far, saying they expect mid to high single-digit increases in overall revenue, with services growth to be similar to this quarter's 13% year-over-year increase and gross margins to fall between around 46 and 47%, even including costs related to tariffs. They did incur about $800 million in tariff costs during the June quarter. Tim Cook did say that came in lower than the estimated $900 million they guided for back in May. And for the September quarter, assuming no major changes, they could incur about $1.1 billion in tariff-related costs. So Cook did say about one of the company's 10 percentage points of revenue growth could be, though, attributed to companies or customers buying more products to get ahead now of these potential tariffs. But again, the most important segment does still remain to be the iPhone. They did say iPhone revenue was strong because the 16 is more popular than the 15 devices versus year-ago levels. And Cook said iPhone 16 sales were up strong double digits versus its predecessor, which they specifically highlighted this iPhone among now users that are upgrading to new phones. They're going to the 16. They're not going back to the 15. The tougher spots, again, were iPad as well as other products division, which it also calls wearables. That consists of the Apple Watch, AirPods, and other accessories, where we saw the iPad revenue fall about 8% and their wearables unit declined about 8.6%. But they've seen success in China. Sales rose 4% on an annual basis to...
Yeah, iPad and wearables, I don't really consider those must-haves like the phone and the computers and laptops and stuff of that nature are much more must-have versus iPads and wearables are something you don't use as often. Obviously, I understand specific businesses. Some people have very, very specific uses, but I don't expect massive growth in that in the future there, just due to how I believe they are more of a, you want to call it part-time, something you need part-time, as opposed to, your phone and laptop, computer and such that you need full-time in your life there. So that right there is why I think we're seeing a lot of that. And more importantly, like a lot of you guys will point out down in the comments, really a whole lot new in regards to the watches, wearables, or the, iPad as well. I don't know. I have an old one and I can't tell the difference between the old one and the new one outside of a few tricks. And I'm sure there's some other things to it. I understand that completely. But for how I use it, there's really no difference between the new and the old for me. And I have this feeling a lot of other folks are in that same situation.
$15.37 billion. They did see, a reversal from the past two quarters in their China unit, where Apple sales actually dropped about 2% and about 11% in the past two quarters of the year. So a lot to like. I think this report you could pretty broadly say was much better than fears and also showed signs that, hey, this company is cash rich and also in a position to continue to grow. Now the next, I think, major catalyst is going to be, what does your product lineup look like for what's expected to be September's, when they historically do launch their next iteration of the iPhone, which I'm assuming will be called the iPhone 17, of course.
Look, it's amazing because they were saying that this round was somewhat impressive, like the 12, the iPhone 12. They were saying there are some real bright spots from way back to the 12. I know the 17 is coming out soon. We always hear about the super cycle, but AI is something that, as you said, Tim Cook is seeing this as one of the most profound technologies of our lifetime, and they plan on being a big player, though it hasn't seemed necessarily that way. They're sort of coming up from behind a bit.
They are. And so that's, I think, been the concern of, like, you have these Apple Intelligence offerings, which I think the first misstep was last year when it didn't roll out on the initial launch of the iPhone 16. You had to wait until October. But now also having Siri delayed and some of its advancements just not really able to compare to, say, even like Google Pixel or Android. But they did have that Worldwide Developers Conference back in June, and Cook did reaffirm on the earnings call that AI is, again, one of the most profound technologies, as they're significantly growing their investments. And he did say they've acquired around 7 companies so far this year, although none have been huge in terms of dollar amount, but they're open to M&A to accelerate this roadmap. As, again, Apple had $133 billion in cash on hand through the end of June. It's astounding. So I think that you look at the threat of the iPhone's dominance with, like, OpenAI and some of these various LLMs, but they said it's difficult to see a world where the iPhone is not right now existing and dominating, is what Cook said on the earnings call, which I do have to say I somewhat agree with. As much of a naysayer as I've been, I am very loyal to the Apple ecosystem.
Yeah, I don't think LLMs are going to get rid of the need for the iPhone. So those type narratives are where Wall Street gets silly. However, I will agree with the narrative that they are behind, and the problem is we don't know how far behind. I think if they would have rolled out Apple Intelligence on time, which is very, very rare, they roll something out and it doesn't work. That's not the Apple way. Typically, the Apple way is we'll wait until it's completely ready, even if it means we roll out the same product again the next year, with just a different little bit of a facelift, and then we'll eventually roll out whatever we want to roll out. So definitely that, and obviously Siri still being like it's, Siri on iPhone 5 or whatever the case was, whatever it came out, I don't even remember. It basically not really advancing much beyond that. Definitely puts them behind. Obviously, they made 7 acquisitions this year. They're not going to tell us what's going on in the background. They're not going to tell us what's working on. unlike Google, unlike, obviously Microsoft, Meta, Tesla, everybody else will tell you exactly what they're working on in regards to AI. Apple will do the exact opposite and not tell you anything until they roll out and it's ready. And again, that's what was not shocking, but when the rollout happened and then it didn't actually release with the phone, it was kind of like, that's really, really, they shouldn't have just rolled it. They should have just waited. And the other caveat that I'll put to, are they behind? Are they not behind? Beyond not knowing what the heck's going on in the background, is I think Apple is going to try to monetize it the Apple way. And I think we got to remember with the AI race, I know I keep saying it, but there's going to be a million ways to win with AI. Maybe not a million, but there's going to be several thousand. It's just like when the internet first started, right? It was just all the things that everybody said was going to dominate the internet. And these were these are the top 3 ways to make money on the internet. None of them ended up being the top. None of the companies we thought, were going to be the leaders ended up being the leaders. And there ended up being millions of ways to monetize the internet over time, right? That's what we're looking at today. But that was unfathomable during the, initial, wow, the internet's here. It's now, it's the future, just like AI. Right now it's here, it's the future. Right now we're seeing that everybody's chasing LLMs. And I'm like, well, right now NVIDIA's crushing it in the AI space. Palantir's crushing it in the AI space, and they're not using that. They're doing something completely different altogether. And again, we're kind of like in that first inning of this entire battle, or this entire race, or the entire journey into AI. So who's to say Apple can't carve out their niche and make a ton of money in AI doing it their way? And a lot of folks want to complain about Apple and they don't innovate anymore. And their phone is, maybe in terms of features, it's the 20th best phone in terms of features. But yet there it is. It's a top selling phone every single year, and it's growing. And it doesn't really matter in the end. As a shareholder for this stock, that's what matters, is that they roll out something that people want and that people will pay a premium for. That's what matters in regards to that. The best solution rarely translates to the best stock. Rarely does that happen. Now, obviously, that's kind of the holy grail whenever you have the best solution, right? And it's also the one that everybody's willing to pay a premium for. And, so it kind of both those things line up. That's kind of what Apple had back, 2007 or so. But it's not required in order to be a behemoth and in order to make crap tons of money over the course of, 10, 20-year period. It's just not. The winner in AI most likely will not be the best AI product, right? Just like the best cell phone in terms of sales is not the best cell phone, right? The iPhone is there. It's not even close, but yet it's not even close to being the best. That's just how business works. That's how a lot of things work, right? We talk about all the time. You can cure cancer, and it doesn't freaking matter if you can't monetize it and turn it into profits. That stock will go nowhere after the hype run, even if you cure cancer. That's just the reality of business versus the best product there. And again, the best product does not always win. As a matter of fact, in a lot of cases, the best product will end up being the flop, and the hit ends up being something that was, 3rd place, 4th place, 5th place, whatever the case is. Right, wrong, or indifferent, it's how it works. And so that's why I don't put Apple completely out of the race. However, I'm also not going to sugarcoat it and say, hey, look, they're all over it. They're just doing their thing in the background, because the few things that we have seen have not performed well at all, or did not happen at all, more importantly. And that is a problem there. So I can't give them a pass on that, but I'm also not going to count them completely out in terms of creating something that may not be the best, but it may very well make the most money. And as a shareholder, that's what matters in the end.
Well, that's the whole thing. I mean, people want to have their watch, their Mac, their iPad, their, pods, etc. Let's talk about Amazon now. Now, this name has been to the downside after the report. Certainly in this environment, it'll be tough to bounce back so quickly, but can probably. But let's talk about Amazon.
Yes, Amazon is a shocking one to me a bit, because this was seen as a major winner. I mean, you just take the street coverage on Amazon, for example. This is the highest buy-rated stock in the S&P 500. It has 73 analysts that cover it, and 70 have a buy or buy equivalent rating. So conviction was strong into this report. Seemingly disappointing this morning. Their cloud segment revenue, though, did still record about 18% growth in the second quarter. That was above consensus, but it is a stark contrast with, like, Microsoft, for example, saw Azure growth of 39% this quarter. Google Cloud reported 32% growth. So yes, now their cloud segment has definitely lagged their competitors, but it's also still one of the leading cloud infrastructure names in the entire market. Just, it's going to face that stiff competition. And now also AWS represents about 18% of their total revenue. And Andy Jassy did say on the conference call that they're meaningfully larger as far as their AWS business versus others. He said the second player is only about 65% of now the size of AWS.
That right there is something you need to keep in mind whenever people are discussing growth rates and being disappointing with a 20% growth rate instead of a 30% growth rate like competitors. When you're the biggest, growing 30% is much harder than when you're small. You'll see that all the time. You'll see a company with $1 billion worth of revenue, we'll say, and I'm just using a broad example here, nothing specific, and their growth rate's at 35%. And then the other company will have 10 billion in revenue, and their growth rate's only 25%. And that's a problem. I really think they're lagging. Are they? Adding 25% on 10 billion is more than they're doing total of the entire other company down there below, including their incredible growth rates at the much smaller number there. So that right there is whenever you start talking percentages, that makes sense whenever everybody's revenue is kind of close. But when your next closest competitor is only 65% of your revenue, guess what? Your growth rate is naturally going to be smaller. The other thing that she failed to point out, and that they discussed specifically last earnings and this earnings, is that they are constrained. They are supply constrained on that end, meaning they can't take on all the clients that they want to. They can't grow the business as much as they want to, meaning there's pent up demand there that whenever they're able to release that and fix basically their supply problem, they're going to be able to then accelerate that revenue again. But that's said in the earnings call. It doesn't go on a pretty little chart and a pretty little quick little thing that comes out, probably AI driven as soon as the numbers come out there. And so they just completely gloss over that as Wall Street. That is our advantage as retail investors, as folks who listen to earnings calls and know, hey, you know what? Who knows what that growth rate would have been if they weren't, supply constrained right now. That's the reality of the situation there. But they conveniently gloss over that. Doesn't make for a good narrative. Doesn't give me a reason to trade the stock down versus up, or whatever the case is. Whatever the algos are doing and everything else. Who knows? You understand also, every single person that goes on every one of these shows on this channel, CNBC, everywhere else, they are trading their book, meaning they're telling you what you want to hear or what they want to hear in order to move their price up and down. The analysts play the same exact game. There's a trade on in the background there. They are trading their book when they go on these shows. You have to understand that and understand the bias in the opinion that is there. And so kind of keep that in mind as you kind of hear things like that. That's why we listen to earnings calls. So we get the actual inside scoop. And that's why everybody's like, oh, man, out of nowhere, this company's booming. How did that happen? And you're just kind of like, well, I don't know, dummy. They said it in the earnings call. It was pretty easy. Just Wall Street wasn't listening to the earnings calls, beat it down. We scoop them up cheap. And then, of course, it booms and it's like magic. The story turns, whatever. It's just garbage in the end.
That still remain the huge focus of the profits for Amazon, as AWS generated around $10 billion in second quarter operating income, though that trailed the estimate of around $10.9 billion. Their total operating income was $19.2 billion. And that was actually some of the weakness that was expected for the coming quarters. As we did see, they gave a slight reduction in their profit and operating income outlook now for the current quarter at the midpoint, though. It was not a huge miss by any means, but that's probably why we're seeing some pessimism today. They did say they'll be opening a new data center in Chile.
Hilarious. They hit the midpoint of their guidance, but, because it wasn't over the, upper end of the guidance, it's a miss. Okay, whatever. Wall Street games, guys. This is what traders do in order to create trades because they make money on the trade. Not whether it goes up or down, just on the trade itself. They take their profits, they move on. Remember, they can lose their clients' money. Doesn't matter to them because they make money on the trade.
Before 2027, and PepsiCo also, surprising partnership, announced an agreement that involves moving its workloads to the Amazon cloud. So another encouraging thing is they highlighted Alexa Plus, which will be their upgraded voice assistant that Jassy boasts will be much smarter than the prior versions of Alexa, and did say they have not seen a real tariff impact, as e-commerce has obviously huge tariff exposure, and some of their lower cost items could be impacted by the de minimis reduction. But they did say no major tariff impact so far. I also thought that was encouraging, but I do think with high expectations came a high bar for guidance, and they slightly missed the mark as far as a few of these profit metrics.
Okay. I mean, it's amazing because most of these names now, we look at the Mag 7, we're waiting on NVIDIA, but Tesla was the miss. But for the rest of the names, we've seen a beats. I mean, even Amazon, you talked about the double beat, but to the downside now. So the Mag 7 is still very much in favor, to your point, with the buy ratings.
Yeah, I mean, nothing would indicate, even from Amazon's report, which I know we were down as much as 8% this morning, but nothing would indicate that there is going to be any slowdown in spend, and that any of these companies are short on cash. I mean, if CapEx has been any indication of the health of these Mag 7 names, sure. Tesla, I think, is its own level playing field because it has more of that autonomy, more of the true auto market exposure that's just going to be, I think, fairly challenged for the coming months. But everything else would indicate, I mean, there's so many good reads on technology, whether it's in e-commerce, it's in AI, data centers. I mean, just some of these companies developing their various own chips now, as well as, I mean, Microsoft, for example, has also a good read on like Xbox. I mean, there's so many aspects of tech that have been, I think, confirmed this week as they're stronger than fears. And also there's no signs of any of the spend in this space slowing, which is definitely going to be a positive indication for, I'm sure, NVIDIA, as well as the rest of the chip makers.
Okay, Jenny Horn, great to see you. Thank you. Happy Friday to you. We'll catch you later.
All right, we'll go ahead and stop the video right there. Obviously we are seeing just incredible growth, and they were right there at the end of the little clip there that, hey, outside of Tesla, which the numbers are going the wrong direction, everybody else is wildly positive, and just printing money hand over fist, and everything just moving in the right direction, despite all the fears, despite, all the tariff noise, everything else going on. That's what you're saying. Oh, despite the massive CapEx spending, you're still seeing, massive numbers coming in for these companies there, which is simply amazing. But coming back to Apple and Amazon, and should you own it, should you not own it, which one I like better, and all kinds of things like that. You guys know I love Apple. It's my favorite stock of all time. But, I can't say that when I look at both of these companies, I think they're in two different spots, and I think they provide you two different types of value as an investor. If you're looking for the more steady play, it's really hard to say Apple over Amazon, but I would lean slightly towards Apple, only because it's more of a steady company in general. The way Tim Cook runs the company is more steady. Amazon at some point in time is going to go into their super CapEx cycle where they expand massive warehouses, massive, amounts of trucks, and massive CapEx spend, not on AI and things related to that, but in terms of infrastructure things for the, retail side of the business, the ordering on Amazon style of business. And that always creates this scenario where it looks like they're struggling. And of course, if you look into the numbers at all, you just go, oh, okay, no, they're just simply expanding that part of the business. They're buying more robots, they're automating more things, which means the numbers look ugly for, a year, 2 years, 3 years. And you see that right there, kind of almost follows the stock price, right? It will have a huge boom period, then it just kind of plateaus and trails down while they're doing all this additional thing to just expand further. Take shipping from 7 days to 4 days to 3 days to 2 days to where now you can get stuff within an hour, depending upon where you live. I was driving out in the middle of nowhere, a couple weeks ago, and there was a giant Amazon facility, and there was not a large, city to be found. And I was like, man, are they getting ready to send, 1 day shipping to small cities? Is it already there? And I just don't know. I mean, it'll be interesting to see how some of those things play out. But I know that CapEx spend will come at some point in time, as opposed to Apple's will be much more steady, just a different way and they run the business there. But I actually like the valuation of Amazon better right now in regards to that. But we just saw during this, past downturn that obviously the money ran to Apple. The safe money, the safe play, it ran to some of the other safety plays as well. But Apple was the one big tech company that it just seemed like, gosh, you can't get a discount. I know we had people in my group. They're like, man, we bought up all the Palantir, we bought up all the SoFi, I want to buy some Apple too. Just, people want to own it for various reasons. And, you just couldn't get a discount. It was still trading at a ridiculously high PE, despite slowdown and performance and everything else of that nature. So there's no doubt in my mind there that's just a different style stock. Maybe some of you guys want that in your portfolio. Again, for a lot of you guys, that might not be right. So that's the reason why I tell you they kind of offer two different value propositions there. But overall, again, solid earnings all the way around. And I really can't complain about it. I own both of them, and I love the performance of both of them in my portfolios there. Again, Amazon, man, what a beast. And it's just, let's see what else happens there. I hope they continue to beat it down, and I hope I get some really cheap shares here over the next quarter, because they, didn't hit or exceed their own guidance. They just hit the mid-tier of their own guidance. Silliness, guys. Just ignore that sort of stuff. Move forward. Listen to those earnings calls. That is the most important piece of it. And if you want to listen to earnings calls with us, and me specifically, go through, our free courses, our free coaching, learn how to become a better investor, learn how to do due diligence, learn how to set price targets and do valuations. Make sure you check out the pinned comment for my group where you get access to all that. The earnings flash sale is ending soon, so check that out. It's the pinned comment. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.